But by other metrics, we're seeing prices fall. And we would not be surprised to see prices fall a little more broadly as the consumer weakens.
That was Cathie Wood in that clip there. Crypto family, welcome back to the channel. Aaron from the Bitcoin Bros here. And if you guys haven't yet, make sure to subscribe, hit that like button. It helps the channel out a lot, and it pushes the video out to more people so they can learn about Bitcoin, crypto, and the financial market. So make sure to do that. But in today's clip, we're going to be checking out a recent clip from Cathie Wood, and she's talking about her concerns with the market going into Q4 at the end of this year and how things could turn bearish. So she talks about a lot of things that could put the markets bearish. That would be bad for Bitcoin, for the traditional markets, for stocks, all of that. And she says there's one thing we need to see before we can get back bullish again and see Bitcoin hit new all-time highs, see stocks hit new all-time highs. So recommend you guys watch this one to the end. Cathie dropping some gems in today's video, and we'll also show a clip after Cathie talks at the end. A lot of valuable information in today's video. Like I said, I recommend you watch it to the end. Let's go ahead and check out the clip here.
The VIX crossed 65, which is the fourth largest measure of volatility in the market, really in the last 40, 50 years. And I've been around for all of them. So it's fourth after 08, 09, the tech and telecom bubble in 2000, and 1987. Now, what does this mean, this volatility alert? It usually means the market is meeting a cathartic moment, or is in a cathartic moment. And it usually means something is changing. And as you know, we have believed for quite some time that the U.S. economy and maybe the global economy has been going through a rolling recession ever since the Fed started raising interest rates. Well, the other thing that was happening during that time, apparently, was an increase in the carry trade involving borrowing yen, so really shorting yen, and buying dollars and investing them into higher yielding assets than in Japan, so playing the spread. The other reason this became a very widespread trade is the yen has been depreciating. So shorting yen meant that the investor or the speculator was benefiting from the yen going down. Well, that changed abruptly this week as the Bank of Japan increased rates more than expected and seemed more determined to continue increasing rates than many people expected. So apparently, lots of margin calls and a sell-off in a lot of assets. And now the VIX has calmed down. Now, we're not sure if the carry trade has unwound completely. JP Morgan is saying we're halfway there. So perhaps we'll see some more volatility, but I do believe that the Fed now is on high alert because the stock market seemed to be encouraging the Fed to hold tight, higher for longer, make sure that inflation was out of the system. And as you know, we've been saying for quite some time that inflation is unwinding much faster than we're seeing in the traditional indexes. Right now, the CPI is at 3.1, but by other metrics, we're seeing prices fall. And we would not be surprised to see prices fall a little more broadly as the consumer weakens. Now, why is the consumer going to weaken or continue weakening? We believe it's because corporations are losing pricing power. And in order to salvage margins, they're going to be doing two things. They will be laying people off, and they will be accelerating moves to increase productivity. So the unemployment rate will go up, that certainly is getting the Fed to change its spots, as we're listening to Chairman Powell. And I think now that household net worth being hurt by the stock market going down is another reason that the Fed is going to relent. Now, one last thought here. Interest rates coming down should be very positive for the equity markets, but they will not arrest a recession very quickly. In fact, if consumers and businesses know that interest rates and maybe prices are coming down, what will they do? They will wait. Now, the market in its wisdom, we believe, is already understands much of what I have told you. And so we do think that lower interest rates, when this carry trade is completely unwound, that lower interest rates are going to be the defining factor in terms of a rotation in the market away from a very concentrated group of stocks to a much broader based group of stocks. And as I just mentioned, innovation solves problems. So productivity gains are certainly what we believe is going to happen as AI proliferates throughout the global economy.
Now, that was Cathie Wood giving her thoughts on the current state of the market. But now I want to shift a little bit to what Raoul sees in the current market. They're looking at some of the same things. You can see what Raoul says in today's video, but he comes to a little bit of a different conclusion. So let me know what you guys think about what Cathie says versus what Raoul says in the comment section below.
I know there's a lot of noise about recession. A lot of that was priced in back in 2022 from the forward-looking indicators. What we've got is the cyclical elements of the economy, car sales and stuff that are slow, miners and stuff that are driven by the business cycle. The business cycle is still chopping. Now, people say, yeah, but look, it rolled down. Yes, it did roll down. It happens at every low of every cycle. You tend to have this correction. And that's where we are now. So you can see the last 2 decades worth, you get this secondary dip before you get the recovery. So that's where I think we are now. It's kind of noise because most of the markets I concentrate on, crypto and technology, are priced off liquidity conditions and financial conditions. But we are at the relatively slow point of the economy where rate cuts are now kind of preordained, and the things that back it up are things like unemployment. I've been talking for a while that unemployment should rise. I don't think it's going to go super crazy, but now we're at the point where we're beyond the unemployment rate of the most negative Fed member. So obviously the signal is there to cut rates, and the Fed have made that clear. Maybe they come sooner, maybe they don't, maybe they inject liquidity in different ways. But either way, unemployment has been rising, and that is a key factor for the Fed, and inflation has been falling, which is the key factor for the Fed. So it's green lights all round to cut rates, and cut rates allows liquidity to come in to the system. So what happened is this mix of the DXY, which is the dollar, and the 10-year bond yields, and Fed rate cuts all came from the Fed starting to suddenly say, well, the market's starting to realize the Fed were going to change course, and then the Fed changing course by saying they were probably going to cut at the next meeting. And that set this whole thing off. Now, there's a lot of rate cuts priced in. They weren't priced in before, but I think they're more correct in how they're pricing things in. Will it work exactly how the markets are suggesting? I don't know. But I think rates come down to 2.5% or lower in this cycle. If you remember, the everything code needs low rates because you have to refi the $10 trillion of debt. So you need low rates to do that and liquidity to pay the interest payments on the prior cycle's debt, which is why the everything code is so important in this and why we keep repeating the same old cycle. It's because it's about paying the refinancing costs of the debt. And we're deep into the refi cycle. So I've been explaining for a while, the Fed and all the central banks need low rates. The Treasury needs liquidity within which to roll that and also to monetize the previous interest payments. That monetization of interest payments is what drives the liquidity cycle and the debasement cycle, which drives up assets. Also, as the business cycle bottoms, people have more money, businesses have more money, gets reinvested, people invest more, and that builds on a cycle. Things like emerging markets do well when the dollar weakens. So therefore, profits get reinvested in the system, and the virtuous cycle of macro summer and macro fall play out. And that should play out all the way into the end of 2025. Okay.